How are you setting up for 2018?
This is really an interesting puzzle because I don't buy the narrative on the TV that this is all about earnings. Yes, earnings have been better the last 6 to 9 months, but they weren't better the last 5 or 6 years. It's been maybe multiple. And if this was all about earnings, your favorite thing, Bitcoin, wine, art, wouldn't all be outperforming the S&P. This is about, in my opinion, central bank radicalism. They're buying at an annual rate $1 trillion a year in bonds in a pretty robust economy. And on top of that, as I'm sure you know, a third of the world has negative interest rates. So this TINA, or there is no alternative, or whatever's happening, this money is obviously going into financial assets. What's interesting about the puzzle they put in front of us is if you believe the central bank schedules, and if you think the ECB is going to stop this nonsense next September, that $1 trillion annual rate is going to go to minus 600 billion over that period of time.
It's a big swing.
Yeah, the other way to look at it is on average, every trading day, the central banks are buying $3 billion worth of bonds. And whoever sold those bonds to them is getting zero, and a lot of that money is leaking into risk assets. So we have the potential a year from now that that 3 billion a day in buying is going to be 2 billion a day in selling. In addition, if you look at the Fed dots, God knows where they'll be after tomorrow, but let's say you think Fed funds next year are going to end at 2 or 2.25. It's hard to believe that a delta of minus $1.6 trillion rate of change in bond buying versus letting them run off, and that kind of tightening, that financial asset prices will be sustained where they are now. But you know, our business is about timing, and I am very uncertain about when this is going to matter. And if you look at traditional market indicators like breadth and all that kind of stuff, they're all still very positive. And it's not shocking because today probably the ECB bought 3 billion. So, but in January that goes to $1.5 billion or less. And then in June, the net with our shrinkage goes to zero, and then it goes negative. Probably going to matter. So
are you going to hang on to Facebook, Amazon, Netflix, Alphabet? Do the FANG names, you just ride this out? I really, really like those names long term, and those 13F filings don't show what I have against them. And it'll be... What do you mean what you have against them? Well, they're called shorts. Are they just hedges, or in other words, are you just hedging your exposure? Are they shorts in other social media companies, or? I don't really like hedging. To me, if something needs to be hedged, you shouldn't have a position in it. But there's so much disruption going on in our economy and in the global economy. There's plenty of opportunities to find on the other side. I think. Like IBM, which you've traditionally shorted? Well, I don't know whether IBM stock is a short right now, but that's the kind of company which to me has been underinvesting, buying back stock, paying dividends while their competitors are basically eating their lunch in cloud and in AI and everything else that is competitively mispositioned. Or like retailers, old line retailers, I'm sure you know this, we have 24 square foot per person in the United States of retail space. China has 3, Germany has 2. I would call that being overstored. So are you shorting sort of a basket of retail names, or? I have been short retail throughout the year, and depending on the time period, sometimes larger, sometimes smaller, and I would expect that theme to continue. So you're hanging on to Amazon even after the run that it's been on? I love Amazon. This company, which everyone keeps quoting the multiple, is selling for less than 3 times sales. Well, who knows? I haven't checked it in the last few months, but the S&P is selling for over 2 times sales. They're dramatically under earning. I don't think looking at the price earnings ratio is the right move here. You have to look at the long-term earnings power of the company, and they are intentionally under earning. They're investing, and
I think Bezos is incredible.
Do you like the Chinese consumer companies for the same reason? Baidu, Tencent, Alibaba, those seem to be emulating Amazon's strategy.
Well, I don't think I'd say they're emulating it. I really like Tencent, and I really like their position. They're in payments. They've got their own version of Netflix. They got their own version of cloud. WeChat is probably the best platform on the entire planet for all of it. And then they have a gaming business. You know, it's funny, if you look at Amazon, AWS is basically funding all the investments they're making in the other areas. With Tencent, their games are funding everything else they're going. So
you own Tencent, right?
Yes. Mm-hmm. Like Amazon, Tencent is intentionally under-earning, and it just, the long-term growth looks incredible. I think it's 40 times earnings, and they're going to grow at least 40%, so it's 1 times growth rate. I still like it.
This is a little bit different, but what about Tesla and Elon Musk? Do you see analogies between what he's doing and Amazon and Bezos, or is that actually for you a problematic valuation story? Have you ever owned it?
No, I'll tell you a funny story about Tesla. I had a guy who managed some money for me come in when the stock was $82. And I think I was 62. So I had given myself a Tesla for my 60th birthday. And he had this incredibly effective analysis, like 20 pages of financials about why Tesla was a short. And at the end of this presentation, really well thought out, I said, "Have you ever driven the car?" Mm-hmm. And he said no, and I sent him his redemption notice the next week.
So you didn't short it?
I did not short it, and I don't know why it never occurred to me at the end of that conversation why I didn't buy it. But no, I don't put Tesla in the Amazon category. They have not proved to me that as a financial model and an economic model it's going to work. But no, I don't like to short great products. That's not my deal.
What about Apple in that case?
Apple, I don't find nearly as exciting as, say, Amazon, Facebook, or Google. It's a hardware company. I understand they have an app platform, but
you use their products. You consider them great products?
I do think they're great products, but they're probably no better than Samsung's. But they have a great brand. I just think I don't see the under-earning that I see in these other companies. If anything, they're probably over-earning in terms of the margin they're making. So I don't own that one. I'm also not shorted. Anything,
I know that you've had a position in Workday, I think, maybe trimmed Comcast. We could talk, Citigroup and Chubb, I think, are some of the, anything there that interests you thematically for 2018?
Well, I love Workday because it fits in the new economy we're talking about. And I think Anil Bousra, who runs the company, is just an incredible CEO, co-founder of, obviously, PeopleSoft and Workday. He gets the whole thing in enterprise. The other names, not that interesting to me.